Hi, this is Lee Thurburn, and this is the third in a series of videos that I'm doing on funding and financing that is designed to help contestants with the pitch competition understand better how to raise capital. We're going to talk about corporate venture capital, or start off talking about corporate venture capital, which is a situation where corporations provide venture capital funds a lot like separate individual venture capital funds will do for themselves. The difference is that corporations provide the funding, whereas in most cases, venture capital funds are investment funds that have been created by a group of individuals that give their money to professional investors that then go out and find a place to put the money. With a corporation, with corporate venture capital, it's a little bit different. The corporations put the money up. This is a set of logos of some commonly known, well-known corporations that have venture capital funds: Intel, Qualcomm, Salesforce, Johnson & Johnson, Samsung, Time Warner, Microsoft, just to name a few. Those are some of the better known names, but there's still quite a few others. And you can just simply go Google corporate venture capital and you can find quite a few of them. Now, they tend to want to invest in the industry and companies that are supportive to or have new technologies within the industry that those companies are established in. That's not 100% the case, but that tends to be the case. Now, if you look at global corporate venture capital activity in the period of 2013 through 2017, the number of deals has risen from a little under 1,980 to about 1,800, a total of 1,791 deals as of 2017. The growth continues to be relatively strong, and the dollars of the investments also continue to get larger. This chart shows the corporate venture deal size overall versus VC, venture capital deals. And the average corporate venture capital deal is, it looks like about $5 or $10 million greater than the average venture capital deal. So, there's a little bit larger deal size involved. The next chart shows the number of corporate venture capital companies that are active at the seed stage, which of course is the earliest stage of investing. So if you have a project that is suitable, certainly I would go out and look for corporate venture capital within your industry and just follow the instructions on their site. They typically will have some sort of a process or a path that they'll invite you to go through and submit your deals. So that would be obviously an option for some of you. Now, the next thing we're going to talk about is the public process, going public. And it's interesting. Going public is actually the least likely way that your business is going to end up. Going public is a very difficult, challenging, and rigorous process that very few companies are able to successfully navigate. There's a number of criteria that public companies must meet, which we'll talk about in just a second. But first, a little chart giving an overview of the sort of the activity levels. Now, this covers 1960 through 2017, and it shows some peaks of activity. You have a peak in the 69 through 72 era, the 84, 83, 84 through 87 era, and then a real big peak, if you will, in the late 90s as the internet kicked in. And then you have a number of troughs. And since the early 2000s, after 9/11 and again in the 2007, 8, 9, 10 time frame, when you had the recession that came on as a result of the financial industry and real estate, you've had a relatively low level, probably close to, say, 200 deals a year if you were to do a regression line. So this just gives you an indication of the peaks and valleys and the number of deals that get done via IPO. A successful IPO candidate will have to have a number of things in place. They're going to have to be in an industry that has a lot of potential scalability, and they're going to have to, as a company, have a consistently high growth rate. So the industry has to be attractive and the company has to be executing well. They have to have a strong record of earnings and 3 to 5 years of audited financial statements. And those audited financial statements are going to have to meet or exceed SEC standards before the various exchanges are going to be interested. You need a solid position within a rapidly growing industry, and the average company age that does a successful IPO is about 10 years. Obviously, you're going to need a sound management team. And it's important, this is not a little deal, it's not just a bullet point. When you go through the IPO process, the senior management team becomes absolutely absorbed in the process for a period of 2 to 6 months. Prior to and during the IPO process. Now, the IPO process is about a 4-month process, but as you're doing your run-up to that, senior management becomes extremely distracted. So when it says a solid management team, what we're really talking about here is not just senior management, we're talking about second tier and third tier management, because the company has to continue to run successfully, and that means that when senior management is distracted with the IPO, which they will be, then the second and third tier of management has to be able to be strong enough to be able to continue to run the company successfully, even with a distracted senior management team. So there are a number of advantages to going public, and this is a decent list of them. That's obviously, first of all, the ability to raise large amounts of capital. When you do an IPO, you improve your public image. The IPO often becomes a sort of branding event. Certainly in the financial world, the financial markets, and in your industry, people are going to notice. But with some deals, it's actually so they become a branding event outside of your industry and outside of the financial markets. You also gain access to future funding. One of the nice things about being listed on a stock market is that not only do you get the initial pulse of cash that comes with the IPO, but you get to go back out and raise additional funds if you want to. So raising additional funds becomes a little bit easier. Of course, that is presuming that you're executing well on your plan, generating positive stock growth and positive wealth creation for your shareholders. You also have the benefit of being able to more easily attract and retain key employees. Obviously, giving stock benefits, stock bonuses, stock incentives is kind of a big deal for a lot of people. You can use your stock to acquire other companies, and quite often that's extremely attractive because one of the things that you're going to want to do is be able to accrete or attract new opportunities from a technology, new opportunities from a market expansion, new opportunities from a revenue generation perspective. All of those things are typically a lot easier to execute on if you have stock that you can use during a negotiation to acquire a company. And being listed on a stock exchange gives you a certain amount of veritas, some credibility, as well as recognition. So it certainly has a lot of advantages. There are, of course, disadvantages with going public. They're relatively minor compared to the advantages, but they can be important. Dilution of the founder's ownership is often the case that it occurs, and the thing about dilution of founders' ownership, a lot of founders have the tendency to sort of think of the percentage of the company that they own as being an indicator of how much they're going to control. But that's a relatively novice attitude. A mature attitude is to realize that a person like, let's take Steve Jobs, for example. When he lost control of Apple, he had a significant position in Apple, but he didn't have control. Most of the time, when you have a company that gets into a public position, you don't have control. He had a significant position in Apple and still lost control of it. Later, when he came back the second time, his His ownership interest in Apple was under 2%, yet he had complete control over that company because of the power of his charisma, his ability to create value and execute on creation of shareholder wealth. And just the guy was, of course, incredible, and very few people are like him. But the important thing to note here is that your ability as a founder to lead the company in the direction that you want it to go, as long as you're creating shareholder value, you don't have to have 51% or some dominant position in the company. Loss of control, of course, is what we're talking about when we talk about dilution of the founder's ownership. Loss of privacy is a very real thing. You certainly hear a lot about senior executives of major corporations doing stupid things. The one that comes to the mind most readily is Papa John's. I can't remember whatever his name is, John, the guy that started the company. He made some inappropriate comments, and the public position that he took on some issues caused the board to become dissatisfied with him, and even though he was the founder, he got kicked out. So, you have to be very cognizant of your position in a publicly traded company, because your personal presence, your personal activities bleed over and impact the company and can have an impact. So there's definitely a loss of privacy. You also have to report to the SEC on a quarterly basis. There are increased costs for publicly traded companies because you have to maintain audits and you have to engage in a lot of additional activities to comply with Sarbanes-Oxley and just the reporting requirements. You are accountable to a much larger group of shareholders, owners of the company than you ever have been before. There are quarterly conference calls that you have to be on for the investment community, and major shareholders are often invited to attend those. There is always pressure for quarterly, rather short-term performance, and you have to be very aware of the timing of your personal activities and pronouncements. Like, you can't just go in and sell a few thousand shares or a few 100,000 shares that you own, because to generate a little liquidity, you have restrictions on that. So timing becomes an important thing to consider. When you're wanting to take a company public, it's about a 17-week process if everything goes perfectly according to schedule, and that is actually pretty rare. Usually there are delays in the process for a whole variety of reasons. You can come back and look at this chart, but basically there's a whole series of sequential events that have to be executed, and to properly execute all of those, it typically takes right at 17 weeks. And again, that presumes that you don't run into any snafus or hiccups along the way. Most IPOs run into at least a small number of snafus and hiccups, if you will, things that can't quite be completed in a most expeditious time frame, and then there are some delays. There's often also what's called the window of opportunity. Most IPOs occur when a sort of ripening of the company and a ripening of the market occur at about the same time. In many cases, the interest that the overall investment market has in a particular space, a particular industry sort of activity, is relatively limited. If you don't accomplish your IPO within a certain window of opportunity, it is very possible that some other company will come along that basically fits into the same space, and they will accomplish an IPO, and then they'll get the first mover sort of benefit, the publicity, often the pricing, and then you become a me too, as an also ran instead of an original thinker, if you will allow me to put that kind of perspective on it. And so once you start the IPO process, a sense of urgency to complete it occurs or happens. It is also extremely expensive. An IPO has these major steps in the process. You choose the underwriter. Now, typically that means that you choose somebody like a Merrill Lynch or Goldman Sachs or some other big company, UBS, Payne Weber. The names change a little bit, but they're always big financial institutions, and that is a major sort of step. You first of all have to find somebody that will sort of sponsor, underwrite you, and then you have to negotiate with them. And if your deal is attractive enough to have 2 or 3 competing, that puts you in a much better position. If your deal is not attractive enough to have 2 or 3 major underwriters competing, then in any negotiation, if you don't have choices, then the other party has more strength. And this is a situation where you're definitely going to want to have as much strength as possible. Choosing an underwriter is an important step. Then, of course, you negotiate your letter of intent, file the registration, prepare and then file the registration statement with the SEC. After you do so, there's about a 2-week time frame where you have to go quiet before you can go effective and go on the road show. Once you meet all the state requirements, which is typically, is an ongoing parallel process to the SEC requirements, then you can go public. Now, all of these steps are the steps that take about 17 weeks to get through. This is just a little bit of a condensed sort of summary of them. Now, your underwriter is going to take typically 7% of the IPO proceeds. So if you raise $100 million, they're going to take $7 million for the process. They're the people that make arrangements to fly you around the country and over to Europe to meet with the big investment banking houses and the big investment funds and the big pension funds that are typically going to put money into an IPO. When you're flying around and doing all this stuff, you're extremely busy. You'll typically do 2, 3, maybe as many as 5 presentations in a day. You'll hop in an airplane in the morning, fly from point A to point B, make some presentations. You may do a couple of hops during the day. You'll go to typically a particular town, spend the day there, hit a half 2, 3, 4, maybe spend the night, hit 2 or 3 the next day, and then fly to the next town. You're constantly making the same pitch over and over and over. And so you're really getting professional in your pitch. The underwriter is supposed to tell you how the deal is going as you go along, but if you haven't negotiated clarity with the underwriter, they may keep it from you as to how well the deal is going, and you do want to have clarity into how many people are making commitments to buy. That is an important step to take. So that's the overall process. Now, your underwriter is going to take 7% of your money. Your accounting firm, your law firm, and the printer are all going to also take a big chunk. Now, when I took the company that I took public, which was called FlashNet, and the time was March 16th of 1999, the deal size that we had at that time was a $54 million deal, which is roughly equivalent today to about $100 or $150 million deal. Kind of in today's dollars, it would have been in that range. We paid about $250,000-$300,000 to the Merrill Corporation, which was our printer, and our audit fees were in the $300,000 to $500,000 range. I do not remember exactly, and our legal fees were in the $250,000 to $300,000 range, and that was for a deal that at that point in time was a $54 million IPO. Now, if you're doing a deal nowadays, I would expect that the price would be about double of what they were then. The commission percentage to the underwriter will still be about the same. Which leads us to the simplified registration process, and I'm going to make that the next video, so we'll end here.